Hello and welcome back to the Nonprofit Investment Stewards Podcast. I'm Bob DiMeo. It's always good to be joined by my co-host and business partner, Devon Francis. Well, the first 3 quarters of this year are in the books, as they say, and yet with elections, geopolitical turmoil, changing interest rates, and a whole lot more, it feels like there's still a lot to be written before we close the book on 2024. We'll delve into all of that in a moment, but first, how are you today, Devon?
I'm great, Bob. Always happy to be here and always happy to be joined by our esteemed Chief Investment Officer, Brad Long. He's been a great guest on our podcast many times before and looking forward to diving into all of those topics you mentioned, Bob. But first, before we get into those specific topics, Brad, could you give us a brief recap on both the stock and bond markets, not only in the third quarter, but also on a calendar year-to-date basis?
Yeah, sure. No problem. And thanks again for having me back, the two of you. It has been a really interesting summer. If you did this sell in May and go away, you would have missed quite a show. The Fed kind of set or really stoked the flames of anticipation in July by holding rates steady, right? The market has been moving towards this narrative of lower rates. And they said, hey, we're gonna hold on for a bit. Then you had some following, that decision. You had some pretty weak economic data. So poor ISM manufacturing data in July, which we received in August, weaker jobs reports, and the market started to hold on to this idea of, the Fed's tightened too much. The soft landing, we're going to miss that landing strip. We're going to have a hard landing here. And we had a lot of volatility, if you remember, in August. So rate expectations really started to fall in the third quarter, and they started to fall a lot in that period of time when the market was shifting from this narrative of soft landing to hard landing. And then probably something in the third quarter that fell out of the back of everyone's mind, but was such an important thing at a point in time was, this unwinding of the yen carry trade, right? We seem to have these very episodic market events where it's like, hey, guess what? SVB just failed. Oh, we forgot about bankruptcies. Or the yen carry trade is unwinding. Oops, even though it was the worst trading day in Japan since 1980, it's a blip on the radar and we move on. So you kind of couple that backdrop in the third quarter, with the pending election here coming up in November. And it was a really rocky August. Now, as we near the end of the third quarter and we look, we're recording on September 30th, so who knows what will happen today. But, all else equal, markets are up pretty materially. And as we've gone through the third quarter, largely described as kind of a period of volatility with the shifting and manifestation of actually coming to an easing cycle. You see the Barclays Ag outperforming cash by about 400 basis points. Small caps outperforming large caps by about 250 basis points. In rate sensitive sectors, things like financials or REITs in particular, up very strongly for the quarter. I think REITs were one of the standouts, up almost 16%. So you're zooming out for the year, very strong year. The third quarter is really defined as that kind of moment in time of the manifestation of actually starting to see lower rates. The only thing I would mention, though, on all of these prices moving, one of the things that hasn't been moving, interestingly enough, is oil. A lot of headlines either this past weekend and over the last couple of months of, the escalating conflicts in the Middle East, Israel increasing its military actions with Hamas and Hezbollah, direct strikes in Lebanon and Yemen, and tensions at certainly a local high, if not an all-time high with Iran. And yet oil prices sit here, U.S. Oil WTI trading at 67 or Brent at 71. And so surprisingly, that's a price that really hasn't been moving with that increase in escalation. And we can talk about that later, but in greater detail if we want. But there's probably two things under the hood there. One is kind of a narrative of perhaps weak demand side, right? The consumer, can they continue to spend? So that's a question out there. And the other is Saudi Arabia, right? They were at one time really defending price at a kind of $100 oil was just what they were targeting in OPEC plus. Well, we know OPEC plus includes Russia. Russia's been selling oil to largely China and India. I think Saudi Arabia, or the market's talking about how Saudi Arabia is kind of sick of paying Russia's bills. And so instead of protecting price, they're going for market share and they're putting more supply into the market. So even though you have this geopolitical uncertainty and escalating tensions, you really haven't seen the typical response from oil.
That's very helpful. One of the things that you touched upon, Brad, was the rocky August that we saw. There was a lot of volatility throughout the month of August. Can you remind listeners, historically, what has volatility been like in the fall months, in September, October?
You kind of pull out your farmer's almanac and you talk about, months of the year and seasons of the year and how they impact volatility. Usually the fall tends to be a little bit more volatile for a handful of reasons. One, the natural cyclicality of summer being a lower month. This is the nonprofit steward. So a lot of educational systems here, those you tend to go into a sleepier period, though I know many on the line are very busy in summer months. When you talk about taxable individuals, you come back from summer vacations, you start to focus on the portfolio a little bit, and then you're nearing tax season. We sit here almost in October. Pretty soon we'll have inked the tax season of 2024. You have to position portfolios ahead of that. So fall tends to be a little bit of that kind of proverbial kick off the dust from the summer and how do I prepare for the remainder of the year? And so as volumes pick up, people are trying to rediscover price. And then you do have the every 4-year cycle, which this year we happen to be in, which is a general election. Elections create uncertainty. Uncertainty creates volatility. And so we happen to be in one of those years. So falls tend to be a little bit more rocky than summers.
That's helpful, Brad. And to your earlier point about sort of the growth scare in August and then some good news since then, tell me if you agree with this. It almost appears that, we were in an environment where bad news was good news because it meant the Fed had to cut. But now it feels more like bad news is actually bad news and good news is good news. What's your take on that?
You're exactly right, Bob. If you think about the Fed and its role in its relationship to markets and the economy, the Fed has two jobs: price stability, right? So making sure inflation is in check, and then full employment. When the Fed is on the inflation horse, right, the price stability horse, that means that they're going to be more restrictive. And so bad news means that inflation is likely to slow down. And with it, the Fed could ease their policies, right? So bad news was actually good in that it built a higher chance that rates would be moving downwards. Now, as the pendulum swings back to the economy, bad news is bad news, right? Because we're not fighting inflation. We're not fighting, but we're more focused on full employment. And so when you talk about things like weaker job growth, the JOLTS data, less hours worked in a week, ISM manufacturing data, when that shows a slower economy, while yes, that might be good news or maybe a tailwind for fixed income as rate expectations fall, it does mean that it actually is a slower economy, not just a higher probability rates are going to go lower. So we have the pendulum does swing. The Fed was very much focused on inflation, 21, 22, arguably 23, and now we've swung back in the other direction. And so therefore the news cycle's also shifted.
That's helpful. And I want to get to the Fed's actions in a moment, but you also, when you mentioned SVB and other sort of unexpected developments, it almost feels like, particularly if the market's getting ahead of itself at a point in time, that an event occurs, and it's not so much that event, but maybe it's been an ignoring of valuations for a long time or overexuberance, and then an event which shouldn't necessarily cause a major pullback or concern, I don't know, just suddenly has investors saying, wait a minute, let me think about what I've paid for these securities. And any thoughts on that?
I think you're exactly right, Bob. There are these, even SVB, right? You had analysts and the Fed and agencies knowing about SVB's, balance sheet and positioning. And all of a sudden it's like a few series of events and it catalyzes this, sea change in opinion. And that's when you had, quite literally the run on the bank in terms of their stock. Same thing we saw here earlier this year. It wasn't one of these things that was wholly new, but it does speak to this kind of built up anxiety that's in markets and, how it kind of feeds on its own narrative. I mean, earlier July, it was, I think July 11th, we saw good CPI data. So that meant the Fed was moving in the right direction. Q2 earnings season was pretty good and we were wrapping that up. Then it, end of July, we had even more escalation from Israel. Early August, poor SIM manufacturing, weak jobs day. Remember that Friday that came about, and there was that Monday, you had that kind of Black Monday, if you will, in Japan. None of those things were particularly either new or unknown, but, the market just kind of grabbed onto them and ran with them. And it speaks to this almost emotional factor that we're certainly dealing with today.
So we've danced around the Fed's rate cut, but let's address it head on. So we're finally here, the long anticipated rate cutting cycle. The Fed at their September meeting cut rates by 50 basis points. What's your reaction to the first cut?
While not unprecedented, it is somewhat uncommon for the Fed to move 50 basis points if you put it in context of kind of today's environment. So again, not unprecedented and not uncommon in a certain environment to move 50 basis points. And the last couple of times we did it, it was March of 2020, right? So we know we were in the midst of COVID there. September 2007, we didn't quite know the GFC was right around the corner, but the Fed obviously knew that the economy was weakening. That fall, to the question earlier on volatility, that fall we saw commodities kind of peak, and then we moved into 2008 and markets bottomed in 2009. And then the last time we moved by 50 basis points out of the gate was January 2001, kind of the cooling of the dot-com bubble. But in all of those instances, unemployment was higher than where it is today and rising. And the Fed was more reacting to that, defending labor side of their demand, as opposed to today. It's a little bit more, I think it's not only shifting to labor from inflation, but it's kind of giving the market A, what they asked for, and B, is that a bit of an acknowledgement to say, you know what, we probably could have gone in July, but we didn't. We're going to play a little bit of catch up here. And they were very explicit to say, don't expect more out of this from us over the next couple. But, I have young boys in the house, you give a mouse a cookie, he'll ask for a glass of milk. The market has already said, thank you for 50. May I have another in expectation? So the Fed is going to have to play a tricky game here going forward to continue to set expectations to say, we're willing to be accommodative. We're data dependent. We're going to react. We're a little late, but we're not going to continue down this 50 path. And I will say, though, be wary of what you wish for. If markets really think they want to see 50 basis points, 100 basis points, the periods in time of which the Fed is cutting that aggressively are the 2020s, the 2008s, the 2001. I mean, markets were down 12% in 2001, down 22% in 2002. Those are periods of time where the economy is materially weakening. So if we do see those level of cuts, right, be wary of what you ask for. It's because we have material rising unemployment, and we're not talking about a soft landing anymore. We're talking about a hard landing.
Yeah, that's a good point for folks to keep in mind. If they did cut by another 50 basis points at the next meeting, that might signal more trouble than, what we want to be in. So I know that, you're not going to prognosticate as to what the Fed will do every step of the way. But if you had to give your assessment of your expectations on a go forward basis from the Fed, what do you think directionally in terms of magnitude, that sort of thing, timing? What do you expect?
Other than the 50 basis points, which is pretty contentious, and usually markets are fairly good predictors kind of leading right up to the Fed meeting. So, if markets believe it's going 25, the futures will show you 25, or 50, they'll show you 50. Leading up to when the Fed cut, it was almost right down the middle. It was like 37.5 basis point expectation. So the markets were really uncertain. It's because the Fed is usually very communicative, and they want to avoid the taper tantrums, that we saw under Ben Bernanke when the market is unaware of what the Fed is doing. The main thing here from now is we hope, right? We all hope as participants that the Fed can gradually ease, that we don't get a reigniting of inflation, and we end up back at this neutral rate. And that's the one that I think is actually worthy of more discussion. Pace, again, it will be a faster pace if we have a materially weakening economy. It will be a slow and gradual pace if we don't. We hope for the latter versus the former. But where's the end of the rainbow? So it's this concept of the neutral rate, or R star in kind of the economic parlance. And it's the rate in which the Fed does not have its foot on the economic gas pedal, right? It's not accommodative, nor does it have its foot on the economic brake, right? It's trying to slow the economy and therefore slow inflation. It's this neutral policy. There's been a lot of discussion through academia and market participants around, has the neutral rate shifted upward in today's economy, right? So the past 30 years or more, we've had very benign inflation because we've been in a period of globalizing, right? So we've had a global economy that's been great for prices. So you don't have to, if you're making a product in Des Moines, Iowa, you don't just make it there with high cost goods. You can ship part of that off at a lower cost, and that passes on to investors and consumers as the form of lower inflation. As we enter, and we've been in a period of materially falling rates, right? So lower cost of capital means businesses are more exploratory. That means jobs are more prevalent, more jobs, more spending, more earnings, growing economy. Now, as we have kind of a higher cost of capital, and this idea of maybe deglobalization is too tough of a term, right? We're not just going to close our walls and say, that thing that was made globally is now just, again, picking on Des Moines, is just made in Des Moines. But you have these deglobalization, decarbonization, which is very expensive, and deficits, which play an inflationary role on the economy and markets. Now, the flip side of that, you have demographics slowing here in the US, materially in China and other parts, and technology. Kind of think of the Moore's law of technology, right? It makes productivity higher, and so inflation is lower. Those are the two secular points that are fighting one another. And recently, deglobalization, decarbonization, and deficits are rising above demographics and technology. And that might mean that the neutral rate shifts up. So historically, this is how it usually plays out. If the Fed's target is 2% inflation, then historically it's been about a 1% real rate. So that would put you at 3% as the neutral rate. But if that rate is shifting up because of those trends that we mentioned, then your landing point might be a little higher. Is that 3.5? Is it 4? Is it 3.25? We don't precisely know, but it's likely that it's moving up a little bit higher. So let's just say, for good measure, 3.5. It's still 125 basis points from where we are today. That's the equivalent of 5 rate cuts. So, we'll be moving in the direction of lower. The question is pace, right? So that's soft or hard, and then magnitude, where we ultimately land.
So, Brad, that begs the question, what are the investment implications of the Fed cutting rates?
It's obviously, it's a tailwind mathematically for fixed income investors, right? In lower rates, if you have some duration in the portfolio, that means you can't replace the yield that you would otherwise get today. And so that shows up through price appreciation. Now, I will say, those that have cozied up to cash, and it's like, that's you, meaning that's everybody. There's $7 trillion in money market funds out there. So people like to say, oh, no, I didn't do that. That's someone else. Your expectation on future returns in cash have just fallen by 14%, right? They were 5.25. The Fed cut by 50 basis points. You're not, let's just use it with the round math, 475. If I just told you, hey, the return on your portfolio just fell by 15%, and I think it's going to continue to fall, what would you do with it? You'd probably put your money elsewhere. People will probably sit in cash for a while. And again, just that mental proverbial wait for the all clear signal. We know that historically doesn't work. But that's one of the implications, Bob, is as we get towards this neutral rate, eventually this cash will say, hey, let's come back to work. Also, typically in, a more neutral rate environment, that's beneficial for equities, but equities are at fairly full valuation. So it's always hard to say what that precisely means. But I think one of the fairly obvious ones is the implications on cash and their relative value in the market. And it's certainly falling today.
That's helpful. And let's jump to the third rail, if you will. And we talked about elections in the last episode with you in July, but things have changed greatly since that recording. So what's your take, and can you describe the current state of the election landscape?
Oh God, that's a loaded one. You kind of be wary of October, right? So in regards to politics and elections, obviously we have no idea. And if this election has done anything, it's proved that kind of the unknown, or the left tails or the third rails, they're likely to happen, if anything else. So who knows what we'll see for the rest of the month. We've written extensively on this, and we'll continue to say it. Markets don't play politics. And moreover, elections are about promises, not about policies. So for us as investors, right, we can't try to interpret promises into what that actually means to outcomes for markets. We need to look at policies. So the big ones on the table, and the candidates are a little bit all over the map on this, is taxes, deficit, decarbonization, China specifically, and foreign policy. Those are a lot of big bites at the apple. As we look at betting odds today, right? We're not here to predict an election, but it seems more likely that the Senate will move towards the Republican Party, and so now you're really trying to wager on the White House. In a scenario in which you have a split, right? You have a blue White House and you have a red Senate, that probably leads to more steady as she goes. So you'll see the expiration of tax policy. So those are the Trump era tax credits, which will then revert both corporate and personal taxes up. Who knows under that scenario where you'll have on deficit? I think the only thing that you could say is you're probably going to have continued gamesmanship on budgeting and closing government and trying to get deficits in order. But both blue, red, and everything in between have been fairly horrible with deficits, right? We sit at the highest debt to GDP level, only somewhat close to the post-World War II era. And we've accumulated those debts under Republicans, Democrats, Congress, Senate, and executive branch. So, all are to blame. And then on the other kind of points on decarbonization, that's expensive, right? Moving from a fossil fuel-based economy to more of a sustainable-based economy. That is, as we talked about, inflationary. So there's a lot of promises out there. There is not a lot of policy to bite into. So, post-November election, we'll have at least clarity of who will be sitting in those seats and maybe probability of what will come forward, right? The probability of a tax, overhaul, the probability of material, change in our relationship with China. But until then, right, we really shouldn't be trying to read tea leaves on promises before we can really take a big bite at the apple.
And I think it's important to underscore, and this is something that you've shared with folks many times when we've talked about the elections before. But when you sat down with Liz Ann Saunders a couple of weeks ago at our client conference in Chicago, and Liz Ann, of course, is the chief market strategist of Schwab, she was talking about the historical records of had someone invested only under Democratic leadership or only under Republican leadership versus having stayed invested throughout the course of, any type of leadership. And the results were just really staggering. So as you opened up this conversation by saying, I think it's really important to reiterate that you shouldn't let your politics drive your investment decisions. In the long run, markets tend to go up. And if you stay invested, then that tends to reap the largest benefits.
Yeah, I think her figures were investing post-World War II. If you invested, $10,000 under just Republican regimes, you'd have $120,000. If you invest, and these are round numbers, if you invested under just Democratic regimes, you'd have $300,000. Like, wow, what a gain! Look, everyone should vote blue. If you invested under both and didn't touch it, you have $38 million.
It's a pretty big delta.
Comically different. And what that speaks to, it speaks both to markets don't play politics, but also just the power of compounding. Compounding interest has been noted as kind of the eighth wonder of the world. And, if you're trying to, just like in 2016, people were really worried what would happen when, Trump got elected. So they sell their cash their portfolios to cash. They were really smart and good for a day. And then the markets took off from there, right? So trying to time these things is difficult to say the least, but it ends up being often or very often not fruitful at all.
So as we wrap up, are there, and stepping away from the election, but just thinking about the current environment in general, are there any asset class or strategy considerations that you want to leave the listeners with?
I don't know if it would be asset class related. We do have, maybe some economic related elements that are going to be perhaps working their way in. You see some of the labor issues and strikes that are out there. Boeing is exemplifying that, in the northeast of the country, but you have, shoremen, all up and down the West Coast talking about potentially going on a strike. Pretty soon we'll be talking about the holiday season and, spending around that period of time. The sensitivity today around labor, unemployment, wages, and a soft landing, there's going to be a lot of noise in that data. So there's probably going to be trading days in which market expectations are X and it looks materially worse or different. And it might be because of a union strike in the Northwest. So I would just say guard against some of these easy knee-jerk reactions when you have a preconceived notion of, well, what if we go into a recession? Because we're seeing noise in the data and we anticipate that noise. So, don't be on high alert for some of that, because we do think there is just going to be a little bit of volatility ahead.
That's really helpful. So we have covered a lot today, talked a lot about the current landscape. Anything you'd like to leave listeners with, anything you'd like to add or underscore?
No, I'm just say, if you got a plan, stick to it, right? We're in the middle of the game and now is not the time to change the game plan. So stay with it. And we're almost at the end of the year and now is not the time to shift.
It's a helpful reminder. So always great to have you on the show. We really appreciate your insight, your expertise, and thank you for your time and efforts.
Yeah, thanks so much, Brad. It is always great to have you on the show. And some of the statistics you mentioned regarding Liz Ann Saunders, she's got a lot of really great content. Encourage folks to go to schwab.com for specifics on that study and more. Directionally, I think Brad nailed that. It's just a giant gap in terms of outperformance by staying invested historically. So this has been great. If you are someone who oversees an endowment or a foundation or pool of monies and can benefit from informed input, please, as always, feel free to reach out to me or Devon via LinkedIn or at the email associated in the show notes. And to all you good stewards, thanks for investing time to help your nonprofits prosper. We'll connect with you soon on the next episode.